Hello, everybody. My name is Eric Bird. I'm your host here at StopStrugglingNow.com. And today we're going to talk about real estate. I've been promising real estate talk. Lots of people have been contacting me to improve their credit score so they can buy a house. But hold on, just a minute. Wait a minute. We may have an economic crash coming soon, similar to 2008. So why put yourself into a house now? So I'm sitting here right now in Fort Myers, Florida, and you can see over my shoulder that we have homes for sale. It's unbelievable seeing how I'm a California kid, homes in the 200,000s, unheard of. And you might think they're garbage, but look at this behind me. That's what their models look like. Hopefully you can see it. I got a blur on the screen. So we're gonna talk about this, plus about some strategy. So please like, subscribe, and click the bell below so you get the latest updates. Now, let's get to it. All right, welcome back. Real Estate Day. We're going to talk about residential and a little bit about commercial. So let's start with the numbers. Oftentimes in the last previous videos you heard me talking about 78% of workers live paycheck to paycheck. And the reason why this is significant is because a lot of you have asked and requested information on how to boost your credit score so you can buy a house. And remember in the intro I said hold on, wait a minute, because there's factors going on in America right now where we could have another crash similar to what happened about 10, 11 years ago, where homes were at prices maybe just a little bit less than what they are today, and then they dropped to nearly half price. So if you're one of these people who buy a house now, and if there is a crash, whatever you put down, you've lost, because that means it'll decrease in value. And therefore, wouldn't it be better to pick up a house at a lower price? So then that way you have an upside. So the reason why I started off with this, 78% of workers live paycheck to paycheck, is so that you understand 8 out of 10 people. And with that, when you say I'm going to buy a house, a home may or may not go up in value. Sure, traditionally over the last 40, 50 years, homes rise. Why? Because inflation. It's kind of like not having anything to do with anything other than the fact of you're going to hear your realtor say, hurry up, there's more people putting in offers. You're going to hear gurus talking about, oh, they're not building any more land anywhere. Okay, like all of America is built on? Hardly. Everybody in America could probably live in 3 or 4 states if they was all crunched in. So there's plenty of land, plenty of property around. So all these buzzwords to get you to buy now so that they get commission, these are the things most people don't think about. And then they have you believing that your home goes up, and they have you believing a home is a asset. But somebody should explain to me how it's an asset when I'm buying something for, let's say, $200,000. And over the course of 30 years, after you put in all the numbers, I somehow paid potentially $500,000. But at the end of 30 years, is the house worth $500,000? Keep in mind those monthly payments, there's interest payments on top of it. But we won't get into that today. What we're going to get into is this 78% or 8 out of 10 people are living paycheck to paycheck. And when you have to qualify for a house and they're taking 30% of it, your debt to income ratio, we're going to get into all that. That's factored in to what you can afford. People are thinking I'm going to get a $500,000 house. Well, if that's the case, 30% of all your income and your debt to income ratio is going to have to be a certain number. But anyhow, let's get down to it. Looking over some other things, you can see right here, Adam data. All right, there's a potential. There's about 5 million properties that are underwater at this point in time. All right, when this came out for Q1. So here it is. You can see it's dated May 7th of 2019. So 5 million homes underwater. That's not that many considering, in America there's millions of homes, hundreds of millions of homes. But this is a trend that could potentially start a downward spiral. And underwater, just to be clear, is when, let's say you bought your house for 300,000, but today the house is worth 250,000. That's underwater. And for this representation, they're using 25% as the number. So if it's 300,000 and your house goes down 25%, which is 75,000, 3 times 25, that means the house has dropped in value to $225,000 or less. And as you can see, they're talking about 5 million properties, which is 10% of the U.S. properties with mortgage. Now, 10% to me, that's quite a bit, but you can see what can happen if that doubles and gets to 20%, and then all of a sudden people are walking away from their homes because they're sitting there going, I'm paying $300,000 mortgage plus interest, but my house is only worth 200 grand. Now you're sitting there thinking, man, I'll just walk away, which is what happened in 2007, 8, 9. And that's why there was a ton of properties available for cheap. And this is why, keep in mind, I've been harping on increasing your credit score, boosting your credit score, and getting extra income coming in the door. Because you and I and everyone can jump in if you have the proper credit and you have the proper income when properties go down in value, and you can buy multifamily properties. You can buy residential properties if that's what you want to do and rent them out. But if you're able to buy a $300,000 house today for $200,000 or $175,000 later, you have now purchased your property at the right price, and therefore you can rent it out and have a positive cash flow. Versus if you buy a $300,000 house, your mortgage note's going to be higher, so now you may not be able to have a positive cash flow right away on that property. It's much nicer if you're able to buy a house and your mortgage payment's $800 and you can rent it out for $1,500, where everything is paid plus your interest plus even water, sewer, some of your taxes. That's a beautiful thing. So there's a big difference. So this is why I say, hold on, wait a minute, don't buy a house yet, because we haven't cleared the hurdles. It looks like there's going to be another recession coming. And if you can wait a year, 6 months to a year, year and a half, you will be in the driver's seat versus being potentially one of the people who buy a house now. So anyhow, let's get to more of this. Over here on the right hand side, this is one of the things that people talk about that they gloss over actually. See this over here? Property taxes levied on single family homes increased 4%. $304 billion in all of America. That's how much they're collecting on taxes approximately if you own a single family home and you're paying taxes. This calculation is also not put into a lot of people's thoughts. When you buy a home, your taxes could be anything. Let's just say it's $500 right now in 2019. But in 2021, it could be $525 in taxes or $550 in taxes per year. It's going to go up because there's inflation. There's a cost of goods and services. They increase. So therefore, it's going to go up. And again, this is something that if you're buying for yourself or if you're buying to make an investment, these are things that you need to consider. Now, let's get on to buying. Debt to income ratio. A lot of you think that just because you have an 800 credit score that you can go in and buy any house you want. That's not how this works. You do need, let's just say you need like a 640, a 620. I mean, if you get an FHA, you can get even a 600 credit score can get you an FHA. It's just that if you get an FHA loan, keep in mind that's a federal loan, and there's other little hoops that you have to jump through, and they charge you what you call MIP, which is basically they secure the loan by having you pay for insurance on the loan itself. So it's kind of like a double thing. You could have a $300,000 FHA loan, but because it's an FHA loan, they want to insure it, and so therefore you might be paying extra points like $1,000 more, or you might be paying an extra $250 more because you're paying for insurance, so if you default, they get their money back. Versus a conventional loan, there is no insurance added to the loan, it's just a loan amount, but the insurance loan is going to require you to put more down. An FHA loan, you can get away with 3.5% down. This is for residential and commercial, and you have to live in the property for at least a year. This is how people start off in investing. But anyhow, let's get to debt to income ratio, and you can see right here this 43%. If I'll try to gloss over it, I guess, but no, we won't gloss over it because this is highly important. Just what it says right here is all of your monthly debt payments divided by your gross monthly income. So basically what they're trying to say is, let's just say you make $9,000. I'll try to keep this simple as possible. $8,500 a month. And the reason why I'm using that number is so we come up to $100,000. So if you make $100,000 a year, I'll do it yearly so it'll be easier to explain. If you do $100,000 a year, and that's your gross income, and then with your car note, your credit cards, with everything, student loan debt, every debt combined, if it equals $43,000 a year, then you will not qualify for home. You will not be able to buy a house. And the reason why this is significant, the reason why I pulled this up under the Consumer Finance Protection Bureau, anybody that's able to get up to 43%, that's in the danger zone. If somebody's using 43% of their gross income to pay for their house, they're usually going to end up in a bad situation because of default or because of health reasons or unexpected expenses come up. And keep in mind, unexpected expenses when you own a house is the air conditioner goes out and the AC unit is like $5,000. Okay, water heater goes out. Who's going to put that in? Yeah, the water heater might cost $500-600, but if you don't know how to put them in, you might have to spend equally that same amount of money for somebody to put it in. You never know what's going to happen. Water leaks, like what happened at my house, where the ceiling all of a sudden caved in from a water leak that we didn't even know nothing about, and the next thing you know, you have flooding in your house due to you didn't even plan for none of that. And now rooms are not being able to be used, but yet you still got to pay a mortgage note. All right, yeah, you have insurance, but you're still gonna have to pay a mortgage note, and you can't even sleep in your bedroom. You can't be in your living room. You have workers coming in and out, and none of that. You don't get to call up the mortgage company saying, "Hey, we have a problem at the house. Well, can you give us a reduction?" No, it doesn't work that way. So anyhow, this 43% number is not something that you should be using. That's the cutoff rate where you're in trouble. If some mortgage company is gonna allow you to get up to over 40% for your debt to income ratio, also known as D as in David, T as in Tom, I, DTI, do not do a loan, because that means you cannot afford that house. FHA, conventional loans, they want you to be in like 35 to 36, 37%. They may let you do that, but if you're below those numbers and you have, let's say you have a 680 credit score and you only have a debt to income ratio of 25%, all right, they're going to get you a loan, all right? But let's say your credit score is 600 with those, and you have a 37% DTI, now you're going to have a little problem, all right? The other thing is, the reason why you want your credit score up there is because they will give you a better interest rate. So instead of, if you have a 750 credit score, you might be able to get a loan right now for 4.3%. But if you have a 660 credit score, the way they're going to do it, then you might have a loan of 5%. And keep in mind that interest that you pay adds up. That is drawing your wealth away. People are thinking that it's simple, that a home is, like I said earlier, you buy a house for 300 grand, then you say, well, 10 years or 12 years or 15 years from now, you sell it for $375,000, and you say, oh, I made money. No, you did not. You lost money. Okay? Now, if you bought the house this year for 300 and sold it next year, or 5 years later for 375, then you probably made some money. But it's not going to be significant where you can retire. So just keep all this in mind. That's why you want to, where you make your money is when you buy the property. That's where you make your money. It's not after you bought the property. You have to know how much the value of the property is and what you can sell it for later, and it's based on parameters. So anyhow, the DTI, that's very important, and that's what you need to know. Just keep in mind you want to have a 35% or less DTI, and your credit score, you just want to make it around 700. You'll qualify for almost any home you want. Then it turns into how much of a home can you qualify for. A jumbo loan, it depends on where you live. In certain states, a jumbo loan is 460. In states like California, New York, a jumbo loan starts at around 600. So you can get a conventional loan up until these amounts, but after that, now jumbo loans, interest rates are a little more, and again, you're going to need 35% debt to income ratio or less. All right, and then it correlates. The higher your credit score, generally, the lower your interest rate is for your mortgage. All right, that's why people want their credit score to be high, and that's why everybody should be working on getting their credit score as high as possible right now over the next 6 months. That's what you have, and then you can join me and everyone else in the big payday that we can get later. When all this stuff goes to crap, we can pick up inexpensive properties, then rent them out. All right. Now, I said earlier something about your real estate agents. Zillow, Redfin, these are sites that you can look up properties. All right. The dirty little secret about Zillow is these guys then went around and they now bought a mortgage company. All right. So now, do you trust the property values on Zillow? They have a vested interest to make sure that the prices showing are high as possible, because they can possibly get you a loan or go through one of their loan servicing providers and they make money. That's their business model. So you have to keep in mind, again, when they're telling you this is the price, you have to go do your own research. And on Zillow, you can actually see, here, we'll do it this way. You can actually see where, how much a home sold for recently. All right, they have these parameters in here. So see, we can do sold. This is in Fort Myers, Florida. Some people believe, what's this here? This is El Dorado Hills. Okay, well now you guys know where I used to live. All right, El Dorado Hills, for instance. Here's some. Let's go somewhere like this here. We put parameters in here. There's these. Okay, I was in Fort Myers, so I used that parameter. Let's go to where we're in Cali, where we'll add on some zeros. There we go. All right. Now, let's just go. Well, these are unreasonable prices. If you're not from California, New York, or in a big city, these prices are kind of crazy. All right. So, with Zillow, you can see here they have the selling price. So see, it sold for $675,000 a year and a half ago, almost 2 years ago, and they're trying to sell it for $100,000 more in 2 years. And you can already see where they had the listing earlier at a lower rate, and then for some reason they upped it to $775,000. Well, the reason why is the real estate agents are sitting there telling them this is how much approximately the house should be almost selling for. And then they'll use these parameters. And then you don't know if Zillow or Redfin are actually padding these numbers. And so, as you can see, the prices vary, and it depends on where you are in this neighborhood, right? Just like anywhere in the United States. So all I want to say is keep in mind when you're buying a home, don't get caught up into there's 10 people also looking at this house. Don't get caught up into this just came out on the market yesterday and we'll probably have 5 offers in the next 3 or 4 days. Don't get caught up. Don't get in a rush to buy a house because there's another house for sale. All right? Don't get caught up. You're going to love more than one house. And in fact, if the house has been built since 2000, in most areas, the builder uses 5 or 6 different floor plans. So there's going to be that exact same house up for sale in the next few months to a year anyhow, and it might have improvements that this house you're looking at now didn't, or that house may not have improvements where you feel that the other house had too many improvements and you're going to pay too much. So there's always more ways to skin a cat, and don't get caught up into when they're trying to rush you, because once you're qualified, they know you can buy the house. Now it's all the buzzwords trying to get you to move. All right? Just take your time. All right, Redfin. I will mention that briefly. And this is, see this here? Real estate agents pay as low as a 1% listing fee. Zillow and Redfin, and there's a few other companies that are out. Purple Bricks, things like this, where real estate agents are under siege, where you used to be able to get 6%. And then if you weren't the broker, you would have to split it with your agent, 3%, things like that. There's companies coming out that's trying to streamline it where they'll only take a 1%, 2%, 3% fee. So real estate agents, you have to be smart about marketing. Now that we went over the residential, there's also, most of you want to get into commercial. And commercial properties is no more, no less than this. Think about this. Let's start small. I know there's gurus out there that claim that they don't mess with anything below a certain like 20 or 30 unit complex or whatever that nonsense is. The bottom line is, when they had no money, ask them how they started, because they damn sure didn't buy no damn 20, 30, 50 unit apartment complex. They probably did it just like we're talking about here. Bought a single family home at the right price where they can rent it out and make some money, and then they flip that into something else. And then from there, so because they had profit, you can flip it into something else. So what we'll do is we'll talk about commercial. And commercial doesn't mean what some people think it means. That doesn't mean you have to buy a multi-family unit. Commercial could simply mean I'm buying a home and I'm renting it out, or I'm buying a condo and I'm renting it out. I'm buying a mobile home in a mobile home park and I'm renting it out. That is commercial, meaning someone else is paying for your mortgage or loan if it's not free and clear, and you're making a profit or breaking even or have a reason to have it rented by someone else. That is commercial. All right? So you don't have to think you can't do it. You can buy a single family home, and if you buy it at the right price, there's areas in the United States, if we're talking about, let's say the southern states, Louisiana, Alabama, Mississippi, Tennessee, places like this, Georgia, there's places where you can buy homes under $100,000, have a mortgage note for $400, and rent it out for $500 or $600. It's doable. Cleveland, Ohio, for instance, you can buy fourplexes for $150,000 or $120,000 or $100,000. Okay, sure, the places might be 40 years old and they might need a little work, but even with the little rehab work, you still are way ahead, because you can have $500 to $1,000 positive cash flow every month. So yeah, I said it, Cleveland, Ohio. Or it doesn't even have to be that. It could be Cincinnati, Ohio. It could be Detroit, Michigan, that's been beat down with prices, and pick up cheap property. Now, once you get to a certain level, you can't finance it. That's the only bad news. So that's why you want to do something that's a fourplex property, and will have a value, and you might be able to get an FHA, but it's harder. FHA has rules on what type of properties you can buy, and they want you to have a certain regulations, and they come in and inspect it and has to meet up to their specifications. But that doesn't mean that you have to use them, because they allow you to use 3.5% down. Maybe you have 15,000 and you found $100,000 fourplex, fiveplex, sixplex, whatever, and you only need 15,000 down, and somebody will give you a loan. And now you have only spent 15,000, and now you have positive cash flow. And this could happen, like I said, in Ohio, Indiana. There's a lot of places that if you're willing to look, you can buy commercial property, as they say. And I call commercial property is when you rent it out and you don't live there yourself. Or in the case of what a lot of people do, they buy a fourplex or a duplex. They get an FHA loan. They live in the property because that's the requirement for like a year. They rent out the other 3 units, and because you would have had to pay rent somewhere else, your rent may be lower than renting somewhere else. So therefore, it's worth it to live there. So after a year, then you put another tenant in there. Now you have positive cash flow. And by the way, there's tax implications. Because if you have a fourplex, now you're renting it, it's a commercial property enterprise. Now you can write off some of the expenses because you're renting it out to other people. Anything that you've used to repair anything, that's an expense. Interest on your loan, that gets to be written off as well. A bunch of things. If you have a management fee, those kind of things can be written off. Think about all the different ways that you can have write-offs, and that ends up meaning there's more money in your pocket at the end of the year. Right up front, it may not mean more money in your pocket, but every month your mortgage note is coming down, paid by somebody else. And keep in mind, because you have this as commercial property, you can walk in the following year and say, hey, the cost of living went up, so I got to charge you an extra $25, $35 per unit, which now means your property value just went up since it's a commercial property, because now you're getting higher revenue. So therefore, you can sell the property for more. That's how this game works, and that's why if you can get yourself started, it's better to have something, invest a small amount of money and hold it and have other people pay for it. And then 5 years later, once the rents have increased a little bit, your mortgage note has went down, now you want to sell it, but now you're selling it based on how much revenues you are bringing in per year and how much money you get to keep at the end. And some other investor will come in and say, hey, I like those numbers, I'm willing to pay this amount. And that's how it works. So that's the brief overview on the shorts. But now let's say you're one of these people that says, well, I don't know where to find anything. Everyone heard, well, not everyone, maybe you have never heard of LoopNet. A lot of investors feel that what's left over on LoopNet is leftovers, meaning the commercial real estate agents have already went to their warm market. They've already sent to previous their investors list. They've already tried to sell it every other way but over LoopNet, and a lot of people feel that this is leftovers, this is last, this is it. Well, guess what? I've found properties on LoopNet. You want to know why? Because there's millions of properties available, and there's not a million investors. There's not millions and millions of investors available. All right? People have their money tied up in other investments, so therefore they can't. So you never know what you will find, so it's worth a look. So you simply type in the city, and then of course, as you can see here, it's industrial, meaning warehouses, shopping centers, offices, healthcare. The list is endless on what you can invest in, all right, and what people sell. We won't get into any numbers because it's numbers. Once you get into that, you have to figure out if it's right for you, and it's all based on the numbers. Okay, now LoopNet. Do you see over here CoStar? Apparently they've kind of linked together. LoopNet you can sign up for free to look on a certain thing for free, but then eventually you might have to pay to unlock everything. But the free thing, you can still look up items, and you can still see, and you can still call realtors, you can still email realtors, and you can find out information. You want to have the P&Ls, what I call profit and loss statements. People nowadays are shady. They'll send you P&Ls. They might not be the real ones. So this is why you always say, that's good enough, but I'm sorry. You know what? I need your tax returns. Because if your tax return and your schedule doesn't say that you earned $300,000 from this apartment complex or this shopping center or whatever we're talking about here, then I'm sorry, I'm not counting that this thing makes that much money, because you're not even paying taxes on it. So that's what I go by. So nobody can tell me, send me over P&Ls, which could be faked. And by the way, you also might want to have their accountant sign off on it, because that'll put his ass in a sling if we got to go back to court about this valuation and you lied to me, and now you're trying to keep some monies withheld in escrow or something. We got problems. So you might want to have their accountant or an accounting agency sign off that that tax return that they're sending over to you is legit. So then that way, because an accountant is putting up their license, so to speak, if there's ever a court situation or if you get audited by the IRS. So that's just some things to keep in mind. So LoopNet, yes, you can still find something. Then you have something which is CoStar, which, like I said, they kind of partnered up. Before they used to be separate. CoStar used to have to pay separately as well, which you still got to pay. But they have properties that may not be on LoopNet. That's why LoopNet's considered leftovers. And then we have Arianomy, is what I call it. Again, you can search for free, doesn't cost you anything, and as you can see, this is a commercial real estate database. Now, you can go to Craigslist. There's people selling property there. But again, the same rules will apply. You have to make sure that this is profitable for you to even invest in. Why give your money to something where you're breaking even? I mean, unless that's what your plan is. But most of the time you want to invest in something where you're going to be making money now or making money later. But like I said, when you buy any property, whether it's for investment or personal, where you make your money is when you buy the property itself. The value that you buy the property at will tell you, you can already figure, okay, 5 years from now I'm going to make money. Or 3 years from now, this is my plan. Or I'm going to hold this for, just keep making the positive cash flow come in. Where can I get another property where I have positive cash flow? And the next thing you know, you have 1,000 coming in, 2,000 coming in, 5,000 from the 2 properties, then there's 3 properties where you have another 5,000. So the next thing you know, you have a positive cash flow of $10,000, $15,000 a month, and then you're running on your own time. So I'm already been long enough regarding this real estate, but a lot of people have talked about, and I'll probably have another real estate video where we can talk about the actual investments by themselves. My nephew called me up. He's looking at something in the Bay Area, for instance. I'm not going to show you what it is, just in case there's other investors also trying to do something. But the Bay Area of California, properties are ridiculous. So for instance, he's looking at a duplex, and unbelievably, the duplex is something like $800,000. For that's 2 units, $800,000. Whereas you can go to here in Fort Myers, you can probably get a duplex for $110,000, $150,000. Now, the difference though is he can rent each duplex in the Bay Area for probably $4,000 per month. This is why he has to buy the property at $800,000. Versus here in Fort Myers, he would only be able to rent each side for possibly $1,000, $1,200, $1,300 per month. So now you can see why the difference in price, because that's the difference with how much mortgage or how much somebody would be willing to give a mortgage for that property. All right, because now we're talking about commercial. So Those are the differences that you have, and we can get into this. And if anybody has any questions, you can always email me, eric@stopstrugglingnow.com. If you know my number, you can also call me. But now we're getting so many new subscribers that I don't know about giving out my number, because I could have lots of people calling me all day long, and because I'm giving out free info. This is the No Guru Zone. So I want to thank you for watching. Thank you for listening. And if anybody has any real estate questions, like I said, you can email me, eric@stopstrugglingnow.com. I'll get back to you. I'll try and help you out. I'm not going to charge for it. So thank you for watching. And again, please like, subscribe, and click the bells below so you get the latest updates. And like I always say, it's hard out there. You know, it's real in the field. 8 out of 10 people living paycheck to paycheck. Let's go over the numbers again. 60% of the people, American population, make $40,000 a year or less. Records in U.S. history. The most amount of credit card debt in U.S. history this year. Most amount of stores closing in U.S. history in the last 2 years has happened. The most amount of student loan debt in U.S. history. Somebody's got to pay this debt back, people. That's you and me. That's why 80% of the people are living paycheck to paycheck and then using their credit cards to pay their bills. Record. 90 days late for car payments, United States record. So you know what's coming next. Real estate. Okay? This is why, if you look around, you see lots of people, or builders, home builders, are putting up homes left, right. And you're thinking, oh, it's a booming economy. Wrong. If they're not able to off these homes, some lender is not going to be happy. And we're going to have a repeat where home builders are going to be out of business, because now you're going to see these empty subdivisions that were already see foundations. You see wires for the cable and water, things like that, half built, because they didn't have the money to finish it, and the guys that are funding them said, oh no, we're not going to finish, we're not going to give you any more funds for you to finish, because you're not going to be able to sell it at the prices that you told us you were going to be able to sell them for. So at the beginning of the video, you saw $200,000 for those homes. When the economy starts going down, okay, let me recap this. $200,000, let's say it's $250,000. You roll in there, and then all of a sudden it's like, well, if you want this countertop, here's an extra $5,000. If you want this flooring, it's going to be an extra $10,000 for an upgrade. If you want this carpeting, then it's an extra $5,000 for this. If you want this stainless steel appliances all in here instead of just these plain whites, then it's an extra $5,000. What starts happening in a bad economy where they can't, those upgrades altogether would mean they get to sell the same house for $320,000. When the price of the property starts coming down, now all of a sudden you're going to be able to buy that same house that somebody else paid $320,000 for. They're not going to reduce the price. They're still going to say it from the 200,000s and make it seem like you're buying a house for $250,000, because they're not going to want to piss off the people that had to pay $320,000 for the upgrades. But now you walk in, the economy's going down, and now all of a sudden those upgrades are included for the $250,000. So this is what you got to watch for. Don't fall for the upgrade trick as well. All right? So if you're buying in a new development, think about that. That's how they get you as well. You think the house costs $200,000, and next thing you know, yeah, it's $200,000 without, any carpeting, without what? No walls. I mean, next thing you know, you done paid an extra $75,000 to $100,000 for some supposed upgrade. And when the economy goes south, these home builders are going to be stuck where they can't off these new homes in this subdivision. And that's why you're seeing a lot of builders in the United States building homes, one home a day, so they can potentially get some people to buy the house, because the longer they wait, the longer they're going to be in this recession. All right, so that wraps it up. just giving you a little insight, something to think about. So again, please subscribe if you haven't already. Please share the videos. Please come to our Facebook pages, facebook.com/Stop Struggling Now. Come to the Twitter, Stop Struggling. Come to Instagram, Stop Struggling Now. Please follow us all over the place. I started posting a little more things like quotes, motivational quotes. Now I'm even going to be posting some video content on different platforms, but it's only for intro. It's not for what we do here on YouTube. YouTube, I give you these 20-minute talks. So again, thank you for watching. Thank you for your support. We're approaching 1,500 subscribers now, and I thank you so much. And keep your head up, keep moving, and I'm out.